So today we talk about derivatives, forwards. So we talked about forwards a little bit already in the foreign exchange context, but we can talk about forwards in all kinds of contexts for all kinds of financial securities, futures, options, swaps. So first of all, what is the basic of a derivative? Derivative is simply an asset that is deriving its value from something else. So it's kind of a bet on something else. That's maybe a good way of thinking of this one. For example, you can buy a derivative on commodities, what we will do in a second. We'll look at beef derivatives, currencies, foreign exchange, stock, bonds, all kinds of stuff. You can basically write a contract and say, listen, if this kind of security is going up, I'm going to pay you additional money. Or if this kind of security is going down, you have to pay me some money. Now we can use derivatives as a hedge, meaning as insurance, just as we had the forward just before and with the foreign exchange rate transaction. There we bought or sold currencies in the forward market in order to get rid of our foreign exchange rate risk. So for example, if we are investing in the US and we want to get later our US dollars transferred back into Australian dollars, then we buy Australian dollars against US dollars in the forward market. And that would be for us a hedge, because we know we get US dollars in the future and we want to get rid of them and we want to know now the price that we get. So that's hedging. But we could also use it as speculation. So a speculator basically doesn't have that underlying asset. So in this example, somebody might just buy a forward without getting US dollars in the future. And now if the US dollar is appreciating, that person has tough luck. So for a forward contract, just as beforehand, we're basically agreeing on a certain price that we have to pay then in the future, and that holds true for both sides. We have to fix a settlement date and also the amount that we are dealing. And then these forward contracts are so-called OTC, meaning over-the-counter products. So that means that they're non-standardized, so we could in theory make a forward contract between ourselves. We can basically decide whatever settlement date we want, whatever amount we want. We can really customize that contract. And we see in a second there's future contracts where everything is standardized. On a forward contract, we've got so-called counterparty risks. So it's basically that we sign a contract with somebody else, and if that other person is not good, 1 year later they're in default or they're simply not delivering whatever we agreed on, you're suffering that risk that you don't get the stuff that was signed up in the contract. Also, there is illiquidity. That means because these forward contracts are so customized and also dependent on that partner's credibility, it's very hard to sell them. And that's different to a future contract. I just want to compare these two very quickly. So a future contract has exactly the same idea. You're selling or buying something at a future date, but you agree on the price right now, settlement price. You also write in which amount, but future contracts are standardized. So the dates are standardized dates, always a certain day in the month when the settlements are due. The sizes of the contracts are also standardized. And one of the most important things is the counterparty is not a single person or a single bank on the other side, but it's a so-called exchange or clearinghouse. So the clearinghouse is basically signing all these contracts, and the clearinghouse is considered very, very safe. So the chance that the clearinghouse is just running away or goes onto default, very, very small. So you have very, very little default risk. It's something that you don't have to worry about. And because these contracts are standardized, you can also easier trade them. So if you don't want to have that contract anymore, you can sell it to somebody else in that market. Good. So really, futures and forwards, kind of the same thing. It's just that one is standardized, the other one is not standardized. Where are all these derivatives coming from? So if you talk about shares, you would think of New York. If you talk about bonds, foreign bonds, it's lots of stuff happens in London. But if you talk about derivatives, it's mainly Chicago. And the reason for that one is Chicago is at Lake Michigan, and there used to be a lot of trading of agricultural products. And derivatives basically coming or were firstly invented for the agricultural market. Now, where's that coming from? You can see here corn and oil, or we do beef in a second, the cattle market. When the farmer is planting the corn, it's way before he knows how much the price for corn will be. Now, I'm not a farmer myself. I just make something up. Let's say it takes 4 months for corn from planting for the corn to be ready for harvesting and selling. So, of course, it would be nice to know at which amount of money you can sell your corn by the time you plant it, especially if you have a choice between planting corn and soy, for example. You want to know which one is more profitable, and that highly depends upon the price. On the other side, you've got some customers, for example, Campbell's Soup. So Campbell's Soup needs lots of corn in the future, and again, they would like to fix their price, because the price could be high, that would be bad for them, or the price could be low. And you can see now the risk for Campbell's Soup versus the risk for the farmer is exactly the opposite. Campbell's Soup is afraid of rising prices. The farmer is afraid of falling prices. So what these two can do is simply they can meet early and agree upon a certain price right now that they will pay in 4 months' time. So that's where the basic idea of these derivatives and these futures came from. And because there was so much trading in Chicago historically started making up these products. They became more standardized in Chicago, and Chicago therefore became the major hub in the world for options and futures. Good. The same stuff holds for oil, and I wanted to make this example here with you. So let's look at the cattle future market. So what do we have here? Live cattle future quotes. 106.275, August 2017. So futures are standardized, so they've got standardized due dates. August 2017, October, December, February, and so on. Now what does this one here mean? 106.27. For this one, it's most useful to go here to the contract specs. So one contract is written for 18 metric tons of cattle. So if you're buying one contract, this is basically what you're locked in for. For example, if you go long, meaning you're buying the future, that means you're buying the cattle. And in this case, you can't buy one cattle, but you're buying immediately 18 tons of cattle. Now, the price quotation is cents per pound. So basically what we had there was 106 cents, not $106. So 106 cents for 1 pound of cattle. But one contract is 40,000 pounds, so you basically have to multiply times 40,000. And then you can see already the numbers are getting quite big. So future markets are not a market where you or me are trading. These are very large markets, and in fact, if you don't have the cattle yourself, they are also considered very risky markets, and we see that in a second why. Now, if you're interested in these things for yourself, wait till we come to option markets. So options you can trade as a private person too, but futures usually not. Delivery, settlement methods, so that's basically at the time. How do you settle? You can either settle by swapping over money. So if, let's say, the cattle price went up and you promise to deliver the cattle, instead of delivering the cattle, you can just deliver the price difference between the price that you agreed upon and the market price. That would be a cash delivery, but in this case here, or cash settlement, we have deliverable. That means you basically have to come up with the cattle, literally. Good. And you can see here they're changing, of course, day to day too. So 106 cents. And we've got on the slides examples that are quite similar, really. So long and short. Today there will be lots of special vocab. Long just means you're buying the thing. Short means you're going to sell it. So in this case here, long, you have the obligation to buy whatever item is agreed upon. In this case, you have to buy 18 tons of cattle. And the short position, the other side, they have to sell you then the 18 tons of cattle at a certain price. In our example, the price was 106 cents per pound. Now, how does it develop over time? Let's look at this one here. Let's say the settlement price is $1.10, so 110 cents per pound. This is what we agree upon now. This is what we have in our contract written down. That, let's say, where does it say? February spot price. So let's say this is for February. They agree in February we will change over 18 tons of cattle, each pound at 110 cents. Now, if in February the price is exactly 110 cents, and you've got a contract that is promising you to deliver 110 cents per pound in cattle, how much is that contract worth? Like, would anybody pay you money for that contract? If the contract says you can buy and have to buy cattle at 110 cents, but the regular market price for cattle is also 110 cents, do you have any advantage or disadvantage by having this contract? No, neither. So in this moment, the contract is worth nothing. And that's what we can see here, profit per pound. So in this moment here, if the price is actually 110 per pound in February, the contract is worth nothing. So neither plus nor minus. And we've got here the short position. So in this case here, somebody is promising to deliver the cattle. Let's see what happens if the price goes up to 120 cents. So in the market now, the price is 120 cents. You have written a contract where you promise to deliver at 110 cents. Now this situation, good or bad for you? Bad, because in the market you could sell your cattle at 120, but you have to sell them at 110. That means you make a loss of 10 cents. On the contract itself, you make a loss of 10 cents. So nobody would be willing to buy their contract off you, because if you have that contract, now you have to kind of buy the cattle at 120 in the market and immediately give it to somebody else at 110. So you make a 10 cents loss in that sense. Now 10 cents loss doesn't sound like much, but remember we're talking about 40,000 pounds per contract. So you have to multiply that one by 40,000 to see how much loss you've got on one single contract. We can go into the other direction. What's happening if the price is going down? So if the price is going down to $1, you on the short position, happy or unhappy that you fixed your price at 110? Happy. So because now you get $110, you promise to deliver the cattle at 110, but that means the other side also has to pay you 110, and there's no choice there, right? They have to come through with that money. And that means you basically get 10 cents more than in the market. Or what you could do is you can sell their contract to somebody else. And that other person would be willing to pay you 10 cents for £1 contract. That means for the whole contract that has 40,000 pounds, there would be a $4,000 gain in that moment. And they can see how much leverage is behind these contracts. Because in the moment when you're signing the contract, as we said here on this slide here, so usually what they're doing is on that day, they take as the settlement price the current price in the market too, or the current expectation what the future price will be. So usually in that moment when they're signing the contract, the cattle price is basically here at settlement price. So in this moment the contract is worth, in that sense, nothing. There's neither a positive value attached to it nor a negative value attached to it. But now of course the cattle prices start to fluctuate. Sometimes the cattle price goes up, sometimes the cattle price goes down. And with the fluctuation, these contracts are either gaining in value or losing in value. And quite a lot of that one too. Because initially you don't have to put a lot of money in to get started, and it immediately goes up and down a lot. Good. So in this example here, to stick to this one, so we have a 10 cents drop times 40,000. So in this case here, $4,000 in the minus, the person that signed their contract here beforehand, without putting any money down initially. Good, so that was the short position. Now the long position. The long position is saying they're going to buy the cattle. So that's the exact flip side of the other side. How does it look for him? Well, now for him, of course, because he's guaranteed to be able to buy at 110, if the actual price of the cattle goes up and up and up and up, that's good that he's got that contract, and the contract is gaining more and more in value. So for example here, if the market price of beef is 120, and you've got the settled price of 10, that means for each pound here you make a 10 cent profit, because you get the cattle at 110, immediately can sell it in the market at 120. Because we had 40,000 pounds on one contract, means we had $4,000 profit. And of course, if the price was to plummet, the exact opposite, we would make a loss, and so on. So hedging. I said we can either use it as a hedge or as a speculation. So go to the farmer, or you can just put in here the cattle farmer too. So the cattle farmer is worried that the price for cattle goes down. And he can basically hedge his risks by short selling future contracts, meaning that he's promising to deliver the wheat at a fixed price. Because he's got the wheat anyway, at home, or as a cattle farmer you've got the cattle anyway. Even though if the cattle price is going up, you're not making a real loss. But what you have basically is a fixed price. So instead of gaining if the market is going up, you just stay constant if you have that future. And also when the market is going down, again, you stay constant because you've got your price locked in via the future. That is when you're hedging. So when you've got the underlying item lying around anyway. If you've got the wheat, the cattle, the oil, the foreign exchange, whatever you write the contract on, if you've got that lying around already, then you're basically fixing. You're just fixing and therefore ensuring your future price. Position in the future market, in this case here, is short. Position in the spot market, I find that a bit weird. This is basically what he's got already. Right? So I personally don't find this one very helpful. It's basically that he wants to get rid of his wheat in the future, therefore he needs to have a short position in the future market where he's selling the stuff. On the flip side here, we've got a mill, so they know they're going to buy wheat in the future. They are afraid of the exact opposite risk here of the farmer. They're afraid of higher wheat prices. And if they go long in the future, if they're buying wheat via the future, they've got their price fixed. And then they don't have to worry about any price fluctuations anymore. That means they get rid of their downside risk, so they don't have to worry about rising prices. But also if prices fall now, they're not going to be happy, right? Because they're going to buy their wheat at a fixed price, having that future. Now the book is using a slightly different explanation here. Maybe I should say that quickly. So the book is making a little bit more of a complicated explanation where they're going with the futures here are gaining in value, for example, the long future, if the price is going up. But at the same time, you're losing out in the market for wheat. So for example, this one here is the mill. So this guy here, manager at the general mill. He went long in that future because he's afraid of rising prices. So now the prices are rising. His future is gaining in value. And what we could do is, instead of using that future and getting the fixed price, you could sell that future at a profit. And then buy the wheat in the market at the excessively high price for him now. But the two are cancelling exactly out because the profit that he's getting out of the future is going to exactly cover the additional price that he has to pay now for the higher priced wheat in the market. So if you like that explanation better, just go for it. I personally like the explanation better. If you use it as a hedge, what you do is you just fix your price. And you don't even need to look at the market anymore because you know you get that fixed price, the settlement price.